Welcome to the National Bank of Fujairah Knowledge Series event. My name is Ting Liang, and I will be your host today. This event is part of NBF Knowledge Sharing efforts and will run throughout 2024. Organized in partnership with LSEG, the theme of today's event is UAE corporate tax, where we'll aim to provide latest developments and insights relating to the UAE corporate tax law. We hope that you will take advantage of today's sessions to interact with our speakers and other industrial peers. Without further ado, may I now invite Head of Business Banking, Mr. Rehan Ali, to share his thoughts with us. Please welcome.
Thank you, Ting, and good morning, everyone, and welcome to our first Knowledge Series event for 2024. We did 3 of such events last year, and we thought it will be good to have a refresher at the beginning of this year to see how we can further help you understand and give more insight into the text bit. So thank you all for taking the time for joining us today. We value your relationship that is based on trust and mutual understanding and collaboration for looking after each other. As we know, the UAE has introduced the new corporate tax law, which applies to all the companies working in the country, irrespective of the size, sector, or ownership. This is a significant change that will affect the business operate, plan, and report their financial performance. This event is organized in partnership with the London Stock Exchange, and today we have speakers who will give more insight into the new tax laws, its implication, and what are the opportunities that can be tapped from it. We have invited experts from different fields and backgrounds who will share their insights and experiences and how to cope with the new tax regime and optimize your tax position and provide updates about the economic outlook. It is important to consider that a great deal has to be done by the companies for every business to achieve corporate tax readiness once it's implemented. I would also like to highlight here that NBF, with your support, has recently won the Best Domestic Trade Finance Services Award at the prestigious Euromoney 2024. A big round of applause to yourself. Thank you. And this is in addition to our repeated recognitions at the MIA Finance Awards, where NBF won the Best Commercial Bank, Best SME Bank, and the Best Trade Finance Bank. Thank you. As you are aware, there is a lot of efforts going on in supporting the ESG bit and the net zero aim of the country. So as a part of the NBF journey and commitment to make it net zero, we have today invited Mr. Keith Bradley, who will be coming during the course of the day from the company of Living Business. We ran this program last year with few select companies, and we have decided to enlarge the scope this year to help you with the ESG sustainability effort as well. He will give you more insight how to make it convert to more ESG and how to participate in a more sustainable manner for growing your business. Thank you so much. Without further ado, I will call Ting again to start today's proceeding. Thank you.
Thank you, Mr. Rehan. Let's start with our very first presentation of the day to provide an update on economic outlook, including an overview of UAE economy. Our first speaker for this session is Nikita Pavlov, EMEA Director, LSEG. Nikita has multiple years of experience in various countries across EMEA region at the London Stock Exchange Group. He joined the company with an impressive background in economic and financial research. Mr. Pavlov, please join us on the stage, please.
Good morning, everyone. That's a pleasure. That's many of you I've seen on the entrance staying with me in that long queue For 1 kilometer, we spent 20 minutes. For those of you who came in the car, guys, that's valuable event. So big round of applause, we made it. I have to sincerely apologize for being late for my own speech. So definitely, I promise that I will bring an extra value. Last year, exactly a year ago, we were brainstorming what's gonna 2023 deliver for us. And I've been telling that that's gonna be challenging year, a year of opportunities. Do you know which shopping mall, what shopping mall, is the most visited shopping mall over 2023? Dubai Mall. What a huge surprise. A year ago, in March 2023, could you imagine that we're going to say Dubai Mall, after the Paris, after the New York, so many airports in the world, the most visited shopping center is Dubai Mall. That's one of the beats we're going to speak later, but before, I'd like to go with you for the very long agenda, so please don't be bored. Questions in the end of you on the coffee break. I would very much appreciate all of them. But before we start, 2 questions. Any guesses what number 71 in 2024 means? 71 countries in the world gonna have major election this year. Once again, 71 countries gonna have major, i.e. parliament, presidents, top dogs elections. Based on UN, there is 198 countries recognized in the world. 1/3 of them gonna have elections this year. Is it the opportunity? But we're gonna speak about that more. So, and any guesses what 2% might mean? What? Yeah, good guess. 2% is the key rate or target for Federal Reserve. So they say that officially, that's our target in 2024, come to 2% of the CPI, inflation, in easy words. Again, I will try to use easy words for everyone to be on the same page. 2%, quite ambitious. Why we're going to see that? So that's asset returns year to date. I made that picture literally the week ago, specifically for you guys. What we could see over there, that Japanese market is keep overperforming 2 years in a row. 2 years in a row, the Japanese Nikkei stock index is crashing the market from the performance perspective. Is it good or bad? It's debatable questions because we might speak about the deflation in the Japan. Maybe some of you might remember Shinzo Abe, their very old days prime minister who were fighting with the deflation. I believe 15 years ago, Japanese dream been realized with him. Fixed income benchmarks, the most conservative instruments, are not doing that great. But overall, that picture, and if someone of you in the broker business or doing buying and selling, as of today, 2024 picture shows that this year works for you. This year of volatility, very high volatility, where the standard terms that, oh, we'd rather go conservative, invest into fixed income, and then boom, Japanese market top performer. Commodities, yeah, let's go to commodities. We see that the Brent is the one of the best performer. Boom. Gold, not. But usually, they have a correlation because both of them are conservative instruments for hedging. There are hard currencies, US dollars, euros, yens, yuans. So, and the same with the commodities, right? Gold and Brent, they usually go together because that's the instruments people hedge their risks. But now we see that Brent go upwards while gold is going downwards. That's the chart, and for those of you who more with banking industry, you would love that chart. Most likely you will show it to your management, to board of directors. The last time the Fed rate was on such high level, it took us 13 months to take it down. 13 months. Again, we all know that history repeats. It comes together. It's going to, maybe not 13, maybe not 12, but that happened in the history, that level been there, and it's been for 13 months. And that's very much important. And remember my question about 2%, and that's very unusual for me to put multiple charts on the same slide. But the slide on the bottom is actually the CPI level. The target is 2%. And where is the CPI now? Not even close to that. So it does mean that most likely, in another Fed meeting, which is coming in 2 weeks, they will most likely, again, my honest opinion, I have to say it, not related to the LSEG company which I represent, they're going to keep the key rate. They're going to keep it for the sake of targeting those 2%. They need to do that. They are not ready to go down because otherwise it will just push up the inflation in the country. Global GDP, and I do love the chat, so I paid a lot of attention to the right side. Thank you. I will go to the left side. From the global GDP perspective, again, we stay in one of the best economy. Because if you look into the left-hand side chart, the delivery, how much emerging markets developed into global GDP, it's keep growing. And that's very much important. And many economists say, and I absolutely agree with them, that while emerging markets deliver the numbers, the global GDP is growing as well. While it stopped, the global GDP stagnation is observable. On the right-hand side, we also see that the debt from emerging markets is keep growing, and that's great. And last year, for many DCM departments, debt capital markets, when we had our conversation, I was saying that, look, guys, that's one of, yes, that's risky, that's high rates, that's quite expensive debt to issue, you're right. But it gives you a chance to overrun your competitors, that's true. And when we look into the chart, seems like that many organizations agreed with me, and they assigned the new debt for them over 2023, even with the higher rates. Because again, everything related to the Fed rate, that's true. And their rate is growing. And the advanced economies, they're not, because they're not ready to assign such kind of risk for themselves. And that's where is the advantage of emerging markets comes to. We are ready to compete. And again, that's proper statistics, right? We are now ready to compete with advanced economies. And that's true. And we see that on the chart. And that red big line on the left-hand side actually says that until we stays within the same disproportion, that goes in the favor for emerging markets. That's good. Moving to the right-hand side, so that was like very intense speech, guys. I will leave it for a while. Many of you asked me last year, and I believe I hope I will receive that question today again. Nikita, what do you think that dollars wouldn't stay as a global reserve currency? Because so many New York Times last year, Financial Times last year, all of them wrote the same article, oh, seems like dollar won't stay as a reserve currency. 50% of central banks across the world invest into US dollar as the reserve currency. Half of the world. And if someone says that, oh, in 3 months, guys, just imagine that in 3 months, half of banks, remember, 198 countries in the world recognized by the UN. So, okay, 71 of them going to have elections. The craziest situation. All of them would be anti the US, but US going to have the election. Okay, 70 countries will say, okay, let's rip out of the gold. It's going to be still third. It will take to reduce the level of investment into the US dollars at least 3 years. Based on the calculation, based on the chart, actually that was a huge trend when the euro been invented, the euro currency, right? Everyone, oh yeah, euro, let's invest there. Since 2000s, it took almost 14 years to come down from 55% to 35%. 20%, 15 years. And now we speak about 55%. Yes, and again, there is another chart. Again, today is a very unusual day. I usually speak much less, but again, I'm being late. I owe you guys. So on the right-hand side, that small chart is the other currencies. That's also very much important because for those of you who works with export and import, specifically with Chinese markets, guys, please make a picture of that chart. That literally shows the further trend of the market because that's how global central banks treat emerging currencies. Again, that's very much important. I barely remember myself speaking about that, but that's very important data. Everyone knows that the US dollar is a dominant. Okay, fair, everyone knows that. But that's on that smaller chart is actually shows how year on year, months on months, other emerging currencies moving on the market. And if you see that someone is picking up the pace, most likely it might mean that that currency would be more stronger in a few months or in a few years. So now I believe we coming to the end of speaking about the global markets, equities and bonds, and again and again and again, bonds, fixed income and loans, very good instruments in terms of your own development. Equities are very good instruments for investments. That's my paradigm, my own paradigm. If you want to grow the business, come to the bank, say, guys, we need money, we want to grow. You have some money, go to buy equities, stay with them, ideally take some dividends out, and that's how the market operates. If you don't believe me, that's the chart. The blue lines is the performance of the bonds. Most of them on the left side, they're not performing. Yes, coupons, yes, more conservative, yes, it's above the inflation rate. It's all right. But at the same time, the equities performance, 3 times better. That's the new data being published by the UAE Central Bank, and I love the data. And for those of you who remember myself speaking last year, I've been telling you that, guys, I'm waiting for 2023 data because it's going to keep growing. And I remember that was one of the conference, one gentleman said, how could you be sure? I said, look, that's amazing place to be, amazing place to work, amazing place to build a business. The country where I am from that country, last year, 2,500 companies been opened with that passport I have, right? So I was like, wow. And that's actually another signal that the deposits on the market keep growing, and both residents and non-residents, because UAE is treated as a safe harbor by international investors as well. And that's actually I remember one of the interview from the government, and they said, yes, we compete with Singapore. Yes, indeed. And that chart shows that we are much better than Singapore from the economical perspective, from the interest from overseas investors. They would rather go there, where is the very clear rules, and it's constantly growing. And that's official data, which is very easy to check, right? So it's properly transparent data. Commercial banks also doing great. I mean, definitely left-hand side commercial banks. For those of you who are part of that business, guys, well done. Beginning of the year, amazing. Loans to residents, also in very positive dynamic. Again, it means that the economy grows. And many people, even with my wife recently, we were like, but that's the bubble. No, that's not the bubble. The bubble when you take money and make a pyramid out of it, that's the bubble. But when you take loan to deliver something new, that's another level. Look, let's be honest. Quick quiz. Raise the hand who was thinking that if company promised something, delivered that on time, at the right value, they delivered, that was the best company in the world. Because for me, that's what crucial 3 years ago. If company says, we will deliver you on Thursday at 10 o'clock, that's good. Believe me, 9 out of 10 were not delivering because of many aspects. Now in the markets, it's not enough. The competition is everywhere. Digital. Who used that landline? Because I recently renewed my internet connection and they gave me that phone. I was like, why? No, maybe you will call the laundry. I will not, most likely I will not say the name, but I have the application. But it's like, tick, tick, okay, come, take it, thank you, bye. That's the competition everywhere. You will not be able to compete without the loans. And that's true. That's, again, the paradigm of the market. You might try to do it by your own assets. It will take you 10 years longer. And you will not be up to pick up the fight with your competitors. Coming to the deposits again, I still insist that the UAE market is treated by international investors as a proxy to the hard currencies. We might argue until the morning, but if for some reasons, either sanctions, religions, whatever, you are not ready to invest into euro, into dollars, come to the MENA markets. We have a number of proxies, and UAE dirham is one of the best. And that's, again, proved by a number of statistics I've already showed to you guys. Most attractive slide. Usually that's the moment I will come down for 10 seconds. Everyone make the pictures, because that's the forecast of the oil price for next 4 years. Collected by Reuters, the largest news agency in the world, all together. And quickly, the red line is the pessimists. The gold line, I know that it's yellow, gold line for me, optimists. And the blue line is the mean, median, literally the simple mean. So as you could see, market is pretty much flat. Yes, there are pessimists, but what I do appreciate about the chart, and I know that like the data stays behind, I literally spend like 30 minutes just to find at least one who says below 55, no one. So 60 and above, that's very confident level for emerging markets, that's very confident level for countries who has incomes related to the oil and gas discovery. The hard currencies, and that's very complicated chart for my boss who is from the UK, because every time we speak about my next conference, he said, please don't do it. The green line on the bottom is the British pound's behavior as a hard currency. The only change of the prime minister helped them to twist that negative dynamic. And my boss said, like, that's a bit shame for him, again, for him. It took them so much time to recognize that before that they were having all chances to be one of, like, on the top of that pyramid, right? So now they staying on the bottom, even below the euro from the performance. Again, hard currencies performance, that's very much important for the wording. Overall, what we're saying that US dollars, even the election is coming this year, it stays as a main currency in the world, stays very strong. UAE is a great proxy for the US currency by its own currency. Loans are good. The key rates might stay high for quite a while. Fasten your seatbelt. This year might bring us turbulence because of 71 elections. That's pretty much it. Thank you very much. Would be a pleasure to speak with you on the coffee break.
Thank you, Mr. Pavlov. It was a very insightful session and a great update. Our second speaking update is about UAE corporate tax law. I would now like to invite Dr. Abhishek Jaju, founder and group CEO, HMS Global. Dr. Abhishek is a technopreneur with expertise on tax, strategy, restructuring, compliance, fintech, and ESG. He has advised multiple clients across various sectors, ranging from banks, insurance companies, SMEs, exchange houses, precious metals, trading, family offices, and others on their corporate tax, VAT, restructuring, and transfer price matters. Thank you, Mr. Abhishek.
Thank you. Thank you everyone for having us here. I represent a firm called HMS Global. On behalf of HMS and myself, I would like to first thank NBF Bank for giving us the opportunity to interact with you, present the key updates on corporate tax, a very important and urgent matter which needs to be addressed by a lot of people and a lot of companies in UAE. Today's presentation, we would be focusing majorly on key updates. I am very sure that all of you or majority of you have already been made aware about corporate tax. So we will keep it very practical as much as possible. So before I start, I just want as in the entire audience, just a quick question that how many of you or the company which you represent, whether as a finance manager or the owner of the company, have you registered for corporate tax? Have you started the registration process? Have you completed it? Have you got the dates? As a raise of hands, if we can know, how many of you have? Perfect. So almost around, I would say around 25% of the audience have raised their hands, while 75% are still are in the process or would be raising or would be doing the registration. So today's start, before I go into the UAE corporate tax law or how UAE corporate tax, what are the key features, my first major area and the first major focus would be to take you through the most recent update on registration process. Has anybody been able to read about this recent update by Federal Tax Authority on registration deadlines? How many of you are aware? Yeah, majority of you are aware, right? So as part of this, suppose you have registered your license incorporation date. Let's say it was in January 2018. So when is your deadline to register for corporate tax registration? Sorry? Somebody said 1st of March. I think so. Somebody said 31st May. Any other questions? Any other answers? 30th April, another response which is there. Before I answer this, which I will answer, let's keep our answers with this thought process. Can somebody tell me, are you planning to open a new business as a company, a new vertical, a new license? Any one of you? Let's say you are planning to open that, right? So if you are planning to open that, which means your license date, issuance date will be after 1st of March. That is obvious. So if your license date is after 1st of March, when is your registration timeline? Can anybody answer? Very nice. Some of the audience is already aware. So with this thought process in mind, let me deep dive into the first slide. I think my question was with regards to the registration date for January, if you're irrespective of the year, whether you are incorporated in 1980 or whether you are incorporated in 2023. If the date of registration falls between these dates, 1st January to 31st January, your deadline for submitting, it does not mean that you need to have the registration done and registration number come. Your date and the deadline of submission is, everybody can see, 31st May. So this is where they have mentioned. But one trick question which I asked, that suppose you are planning to open a new business now and your registration or the issuance license date is after 1st of March, then FTA has clarified you have 3 months from the date of the issuance to apply for registration, right? So everybody is clear. So now I think everybody has seen the question, the deadlines and everything. They have provided very important thing on permanent establishment. Anybody who is aware about permanent establishment concept? Yes, sir. You would like to answer that?
But they are not having any office there. So I think it's they will be falling in the permanent existence. So
very impressive. So very close to what exactly it is, that a foreign company, through directly or indirectly through their employees, if they are getting represented here, whether even in a hotel they are doing any road shows and there is a revenue which meets the threshold of corporate tax, they may fall under permanent establishment. Under all scenario, the answer is no, but under certain scenarios. How are those scenarios done? What is the process of it? Today we will deep dive. But to start with, to close our point on the registration side, it has been mentioned that if you potentially have a permanent establishment and from the date you recognize it, you have 9 months to register your foreign company, which is a non-resident company. It may be potentially optional for you, may not be relevant directly to you, but it is important for you to understand that if you plan to do something where you are sending your staff for other countries also, permanent establishment concept is now prevalent. Even in Saudi Arabia, a lot of people want to grow in that jurisdiction. So this is something which you should think. And the vice versa. If a Saudi Arabia company comes here and sets up for a small period of time, there is a revenue, there is an income, and if that falls under the corporate tax bracket, you have 9 months to register from that. The other thing which is also the second part, a person that has a nexus status. Can anybody explain how do you mean by nexus status? It's a very, I would say complicated but a simple concept. So nexus means that you may not have direct operations here, you may not have direct presence here, but there are certain incomes which are taxable under the corporate tax law. And if there is a direct nexus which can be established with the resident person with a non-foreign or non-resident company, then a nexus can be formed. So in this such scenarios, it's a complex scenario, but to simplify it, what corporate tax says that if you have made an income in this country, whether you are resident, non-resident, if you fall above the 375 bracket, you are liable to register and you are liable to pay that tax. So that's the simple part. In that case, what they say is that as soon as you understand that this assessment is completed and there is a nexus, you have 3 months to register as part of your registration process, apply for it, and then the next stage comes. So now, these two important things are there. The third thing is natural person. Has anybody heard about natural person getting corporate tax? What is a natural person? Like an individual, I am providing services. Freelancer, very nice concept. Freelancer is there. A lot of people provide multiple freelancing work and other works, especially income which is generated without licenses, those kind of incomes. What they have mentioned is that if you are conducting a business or a business activity or any other activity and your turnover, here it is very important. In individual case, they have said it is turnover, which means if I provide a freelance service to somebody else above 1 million dirham, then I qualify to register under the corporate tax regime. So if I do that, as part of this, I have 31st March of next year. So suppose I am an individual person, I am providing freelancing, I have 31st March of 2025 to submit my application. So that's the deadline they have given. Now that we understood about the resident company, non-resident company, individual company, I would like to ask some questions. I know the audience would be ready to answer that, right? So the first question which I want to ask is that if your company is incorporated 1st January, I already asked this question at the start. When do you think the deadline would be? Perfect. The answer is right. Let's say if you have incorporated after the law has come on 2nd March this year, when is the timeline to register? Sorry? 3 months, which is 1st June 2024. Coming to the third part, if you are a sole proprietor business or a freelancer business and you have the deadline to register, we just discussed about this, individual registration. When is the timeline? 31st March 2025, we have timelines. So with this concept in mind, why I wanted to present this is, the summary is this, that if you don't follow this regulation, there is a potential fine as per FTA decision number 3, which may tantamount to amount of 10,000 dirham. So we need to comply with this regulation. We need to ensure, go back, check your license date, see the qualification. When you have to register, try to register beforehand, and this will help you meet the requirements of the...
I have a question, Dr. Abhishek. Let's say as an individual, I'm doing business in 2023. So is it that or as a company I'm doing business in 2023, is it that I have to register before that 31st May deadline or only submit the application? Because some tax audits may be going on.
So submit the application. It is the application deadline. It doesn't mean that you need to be registered. The registration process, FTA will take its own time, but the submission, the focus is the submission. That you should submit all the documents and your documentation process should start. That's where the answer is. I hope this answers your question. So UAE corporate tax timelines. I think everybody has been seeing, it started from 9 December when the federal decree law came into picture, number 47. I think majority of you are very much aware about it. I don't need to go much into that. The effective date a lot of people generally get confused that 2024 is our effective date, 2023 is not. But actually, as per the law, 1st June 2023 is the effective date of implementation. Now, why this is important? Because if your financial year, let's say your financial year ending was 31st May of 2023, so which means from 1st of June, whatever business you have done, till 31st May 2024, it will be taxable under the corporate tax regime. So it doesn't mean that it is only applicable on 2024. Why there is a myth? It is, a lot of people say it is 2024 because your financial year is 31st December. So when is your new financial year starting? 1st January 2024. That's why it becomes applicable for you in 2024. So whichever earlier is the concept by the corporate tax law. I hope this point is clear to everyone. Then they brought global minimum tax regime, which is BIPS Pillar 2. Maybe a lot of you who are part of global conglomerate would have understood the 15% minimum tax rate, which has come globally for large multinationals. So that is the rule which has also been, UAE has been signatory to that. Transfer pricing guidelines. Now this is something which I will invest some 10-15 minutes at the end, where we will take you through the practical scenarios of transfer pricing guidelines for sure. This came in 6th November, and now the recent one, which is they have clarified about the most important thing, that when to register. A lot of people were asking, there is no timelines, no deadlines, but now it has been clarified. So this has been the timeline and the journey for you, and we will focus on what are the key features as part of it. So first is your 1st June 2023 implementation. Second is, everybody is aware about 375,000 dirham. Is it net profit or revenue? Perfect. Everybody wants to pay less tax, so it is net profit. So 9% is applicable on 375,000 and above. Anything below 375,000, what is the tax rate? Should you register if your income is less than 375,000? Some are saying yes, some are not saying. You have to register. Are you making losses? If you are making losses, do you need to register? Yes, you have to register, whether loss or profit. If you are qualifying as a small business relief, you want to apply for it, do you want to register? Yes, you have to register. If you are qualifying from a free zone, a qualifying free zone person, you have applied for that exemption, still do you need to register? Perfect. So everybody knows that registration is mandatory for all companies. There is no exception. Am I right? There is exceptions. Every law has an exception. Yes.
Hi, hello. What is the requirement for a dormant company? Do they need to register as well?
Perfect. So my learned audience can answer this question very simply. If it is a dormant company, do we need to register? The answer is yes. Registration is mandatory. Even if it is dormant, it can be activated, right? So either you apply for small business relief that you are not doing any activity as part of that, but still registration is compulsory, because the process of applying for small business relief is also through registration. This is very important. A lot of people ask, when you deal in Saudi Arabia, when you deal in Oman, withholding tax is there. When you deal in Bahrain, what is the withholding tax in UAE? As per Article 45 of the law, they have clarified it completely, that withholding tax as of now would not be applicable. Withholding tax on payments which you are giving to third parties, external parties. So this is very important concept for all of you to be aware of. Does this apply to your business? Yes, it applies if you are doing payments outside UAE. So 0% means, is it a tax rate or you don't need to maintain a record? It's a tax rate. 0 is a number. So they can change it to 1, 2. I'm not saying they will. Don't quote me for that. But I'm saying that 0 can be changed to 1 or 2%. Or 5% or 10% in certain jurisdiction. Or based on the activity, based on the services, based on the related party transaction. So it is very important that from now on, we always advise our clients as AJMS that please maintain the proper documentation on these fronts. Withholding tax is 0, perfectly fine, but if you are making payment to your vendors, keep those records and keep recording as withholding tax 0. so that going in the future, when these tax rates or things got changed, you as an organization are system ready, because your system is also able to capture it, and documentation ready. These are two important aspects whenever we talk about any implementation of the law. So this is very critical as part of that. Provision of tax group, again we will discuss about it in detail, how you can form tax group if you're part of a global group or a regional group or a local group also.
Excuse me.
Yeah.
I have a doubt for registration. Now, as you said that we have the deadlines. Now, if any company which is maybe in Saudi or Oman, Kuwait, but the place of effective management is over here. So first of all, do we have to register? Anyways, I think we have to register, but what would be the timeline for that?
I'm really enjoying these kind of questions. Thank you so much for bringing it up. So this, he brought a concept, what we call in taxicom called POEM. So place of effective management. Suppose I am a UAE resident, and we have covered that as part of it. Since he brought it, we will take that question. So I am a UAE resident director, and I have a company, let's say anywhere in the world. That company is effectively all the decisions I am taking as a resident of UAE. As part of that, corporate tax law has specified that if the place of effective management is UAE, that income and the profit which is accounted from that particular company has to be accounted under POEM, and corporate tax regime would be applicable to them. So if a non-resident company comes to know that they have an effective place of management, when is the registration timeline? We just went through non-resident. The dates are for resident. It is 9 months from the date you recognize that this is, your assessment says that you are qualifying as part of corporate tax regime. So this is how we have to tackle. There are multiple aspects he brought into the picture. POEM concept is a different impact assessment thing which has to be done. As an organization, we need to start looking at it. When we are doing any impact assessment as our organization, we ask our client that whoever are your UBOs, their related entity should be declared, whether here or outside. A lot of people ask us, why are you asking for outside? We are asking for outside because he is a resident of UAE. What role functionally, operationally he has in those companies will help us determine whether that particular company under the POEM concept comes for effective tax. And today, if we don't do that assessment, and when the authorities come, they will ask you for such declarations in the future, and as part of the tax audit, they may find out certain things which may lead to potentially tax penalties for you. So this is better to plan it now, declare it now, whether to us, to your consultant, or whoever your internal finance managers are, and do an assessment as part of it. So I need to rush on the presentation. So quickly we are going into the taxable person part. So taxable person again would define based on whether you are a resident individual. So if you see, we have put as resident juridical person, which is called a company. Leave the complexity part. So if you are a company incorporated in UAE, the entire world income will be coming under corporate tax regime. There is a concept, a lot of you would be in manufacturing and trading and may have operations in JAVZA or other free zone entity for import-export. Have you focused on high sea sales? Have you heard about this? Yes. Can somebody tell me how corporate tax is dealing with it? Anyone? So which means high seal for everyone simply is that you purchase a good from country A, sold it to country C, you are sitting in country B. Your country B is only doing the negotiation from country A supplier, supplying it to country C. The good doesn't touch the ports of UAE. In this scenario, will it be considered, if you are a LLC company, will it be, you will be paying tax on it? Some are saying yes, some are saying no. Who is saying no? Zero rated. Somebody is saying zero rated. So it's a myth. It's very clearly given. If you go with the guidelines given by the authority, they have said that there is a provision we are giving you that if you are in a free zone and in a designated zone and you provide search and distribution activity across the globe, You may qualify for 0%. Today we'll see how you can qualify that. But if you qualify for that 0 rated, then only this will be 0 rated. You have to qualify first. And for that, there are certain substance requirements which you need to do. But if you don't qualify and you are an LLC company, can an LLC company be a qualified free zone person? No, because it's not a part of a free zone, right? It is not performing any qualifying income in a free zone, so it cannot be. So which means what? High C sales for a LLC will be part of their income, which means you have to record relevant expenses for that, which means you have to pay 9% corporate tax over and above your income above 375,000. This is very important for you to understand. So foreign company who is effectively managed here, our friend asked this question, that a company in KSA, I am the resident director, I am in UAE. This is the second scenario. Is it effectively and controlled managed in UAE? Yes. If it is yes, worldwide income of that foreign company will be applicable and you have to do the registration process. Third is natural person. We just discussed natural is individual, 1 million and above. If that is the case, we will go ahead and register. The 1 million is the turnover, not the income. Going into non-resident part, again permanent establishment, legal, natural person, and if they perform those activities, on similar lines, we will move ahead and register. So another question which our team has put across, suppose you have a BVI company and you are the decision maker and you are a resident of UAE. Will you be paying tax on it? Will you register it? Can I get more yes or more no? Yes, perfect. So you will register it because of the POEM concept which we brought. The POEM is called place of effective management. The next question, if you are a sole proprietor doing business in UAE, will export income from Europe be taxable in UAE? Perfect. The answer is that you are making export from UAE, hence this will be taxable in UAE. Taxability of natural person, just a quick thing, what they have said is that suppose I as a individual, I have a property, I am making rent. Will I pay tax on it? Why? Personal income is exempt. So it's called anything what is passive income, what we call active income, passive income if you go. So salaries and other things which is your active income and anything which is your passive income, both under this would be very focused on. Salaries are not taxable, they have clearly mentioned. So whichever is your passive income from investment, from bonds, from equities and other things will not form part of taxability. But what will form part of taxability? Any activity which you done as a business activity. So if you are providing services which is not in the normal course and your time utilization is done, which is tantamounting to above 1 million, then you have to pay tax on it. So these are the incomes out of which business income is very clearly said, turnover above 1 million would be, taxability would be there. Second is employment and personal investment would be exempted as they have clearly mentioned, and these are relaxations which they have given as part of individual income. So another quick question we just wanted, that if you are a sole proprietor business, you have also have a factory in China which sells goods to Europe and America. Will your income from Chinese factory be taxable in UAE? Give it a try, yes, no. Yes, some are people saying yes, some wants to pay government the taxes, very good. Some are saying no, some wants to. But first, let us bifurcate the question. First, am I a decision making in that company? Am I taking active role in that company? By being an owner, by virtue of that, doesn't mean that you have to pay tax. As long as you are an active member or taking decisions in that company, and the decisions are being taken by virtue of you being resident in UAE, you are taking it from UAE, then the POEM concept comes. So since your Chinese factory is your permanent establishment in China, the income is taxable in China. As an individual, you will never be double taxed. So if you have a factory where the decision making is done by you, then I will agree that you will pay tax. But if you are not actively involved in that, there are management, there are people, no need to worry about it. You just need to demonstrate, document, and whenever the tax authority asks you, you present those files that see there is a director, there is a management, all these things are being done. I'm just by virtue of shareholder getting the dividends. Is dividend taxable? Very important question. Good. It's not taxable. Qualifying free zone person. This is another topic which we wanted to cover. It's a very long, exhaustive, but the key substance requirement which would be there for all of you to focus on is that you have to perform qualifying activity and generate qualifying income. There is a huge list they have given. It's not complex, it's very simple. Since some of you may be from commodity side, I will address one part of that so that you understand how you will be qualifying as a QFZP. It does not mean that if you are performing a qualifying activity and you didn't apply for QFZP, you will automatically be coming under 0% regime. To come under 0% regime, you have to comply, you have to register, you have to apply and maintain all these substance requirements. What are the substance? You are not electing for corporate tax. Second, you will comply with all transfer pricing regulation. Third, you will prepare your annual financial statement. Keep it ready whenever the authority wants. Fourth, always make income from qualifying activity and qualifying income. QI is qualifying income. What is qualifying income? In the next slide I will take you through. And there is a de minimis limit of 5 million. Suppose you are an entity, you are providing services, right? You are providing goods, everything which is qualifying income, but you are also doing certain business which is non-qualifying. So they have given a limit for that also. And it does not mean that 50% of your business is non-qualifying, 50 is qualifying, and you will fall under QFZP. They have given a de minimis limit of 5 million, which is important, or 5% of the total turnover. So if you are a 100 million turnover, 5 million or 5%, that is how you have to look at it. This is very important concept as part of this overall QFZP. But the moment you qualify as QFZP, what would be the corporate tax rate for you? 0, exempt, or 9? Somebody said 9. Anybody in the room wants to challenge our friends here? So it is right, 0% is what the corporate tax rate would be. Now what is the benefit of, can somebody tell me one advantage, one disadvantage you derive if you become a QFZP? Sorry? If you elect, there is no threshold, so which means if you are doing any non-qualifying income, you pay tax from 0, which is your net income is even 100 dirham, you have to pay tax. There is no limit. The 375 threshold limit goes away. And what is the advantage? One advantage, very evident, 0%. 0% is amazing, right? So you enjoy the facility at 0%. So that is the key advantage which you will derive. So these are some of the activities, qualifying activities and excluded activities. I highly recommend you to read the ministerial decision of 265 which refers to this. It will be helpful for you. We will share the presentation. I see a lot of you are clicking pictures. We will share the presentation with all of you after the session. But the key decision is, are you doing any of the activities which are falling in these 14 activities? If yes, it is time for you to assess and see whether you qualify as a qualifying free zone person or not. This is very critical and important. The activity is very important and you generate income from that activity. It does not mean that you are doing 80% of that business and you qualify for QFZP. No. It will depend on 5 million or 5%. So it has to be 95% and above. This is a chart which explains under each scenarios how you will be taxable. So if you are a domestic activity done by qualifying free zone person and it's a domestic permanent establishment, if they deal with anybody transaction with other free zone person, it will be taxable as 9%. If they are dealing with non-free zone person, it's taxable at 0. What is the difference between free zone person and non-free zone person? very important, under corporate tax law, they have clearly clarified that non-free zone person means anybody except the free zone entities. So which means what, mainland entity can also come, foreign entities can also come. So this is how you have to evaluate how things will impact accordingly. So 9% in the first scenario, commercial immovable property. If you are renting out a commercial property, you have a property and you're renting it out, then what is the percentage you will look at? So those scenarios in typical multi-scenario development has been done by us. But one thing which is very important is that how you address the issue when it comes to your organization. As QFZP, you have to make sure that you maintain all the substance criteria. Then only all these things will work. If there is, or any of the subsequent year, you don't qualify for it, it becomes a challenging task because you have to go back and you have to maintain the all corporate tax regime. Another question, quick one. If you have a company in Javza that buys goods from India, sells directly to retailers in Africa, will this be taxable in UAE? If yes, how? I don't think it will be taxable. What do you guys think? Tax at the rate 0%. That will only be applicable if I am a QFZP. So my question would be whether I am a LLC or a qualifying free zone person or a normal free zone person. Like the earlier chart we showed, depending on that, you would be able to decide whether you fall under the 9% criteria or 0% criteria. So in this case, it is very important that these three things has to be done. Then only you will act as zero rated. So your company, if it meets all the condition of qualifying income, including designated zone, registration is in designated zone, B2B sales and qualifying activities distribution, then only you will qualify as QFZP and apply at a 0% rate. I hope this important slide is very clear, because that is where you can build your tax efficient structure for your organization, that how you want to do it. Can anybody tell me that if I apply for QFZP, can I merge it or group it with a LLC company which is paying corporate tax? Yes, no? No. Perfect. Because if I do QFZP, I am not applying for CT, so it has to be treated separately. The headache for finance managers would be you have to maintain separate tax provision and tax compliances for QFZP. All the transfer pricing regulation will be maintained, and for LLC it will be separately done. So you have to really evaluate from that perspective. Yeah. Yeah.
So if LLC company owns 100% shares
Yes.
of FZD company,
Yeah.
so in that case, how the scenario will be?
So that will come to the tax group. Now we have come to the tax group. So for forming the tax group, you have to be 95% common shareholding. 95%. So in this case, it can form part of tax group. But if you apply for QFZP, then you cannot integrate it or make it part of tax group. So this is the difference.
In that case, our financial statements are consolidated in LLC.
So financial consolidation is different than tax consolidation.
Yeah. So
Completely different.
tax will be separate in
Yes,
QFC.
yes,
Okay.
yes. Even the taxable income as per FTA would be different than your profit and loss net profit. Because we start our taxable profit of the year with the last line item which you give us from your P&L, which is the net profit. From there we start calculating what are the additions, what are the deductions, and coming out to the final provision. So how many of you are forming groups? Any of you are forming tax groups? You are forming tax group. So what is the criteria of forming tax groups you have thought about? Yes, please.
Ownership, same ownership, and there are related party transaction and all.
Perfect. And when you say same ownership, will 51% and above same ownership also form?
Basically, it's two companies. One company is handling B2B and other is B2C. So
And the common shareholders are there.
yes,
And these common shareholders own how much percentage in both the companies together?
I mean, there are two owners and which are pretty much the same, in the both the
Same
companies.
structure. So
Yes.
100% common shareholding. But for forming tax group, the authorities have clearly said 95% has to be parent company should own or common shareholder should own 95%. That is very important. If it is above 51, it is related party. You can't group them. It is not like VAT.
I have a question, Dr. Abhishek. Because of this qualifying free zone person, a lot of opportunities are coming for restructuring of businesses. If I have a company which is earning 80% B2B sales and 20% such sales which is not a qualifying income, is it a good idea that I split my business and take my B2B activity to a designated zone? Will it trigger general anti-abuse rules in the eyes of FTA, or is it okay to do that?
No, as long as it is done in the normal course of business, it will not trigger GAR. GAR is actually abusing the laws to your advantage to avoid tax. This is very important concept. All of you should be aware about it. Thank you so much for bringing it up, because this is something, the law is very clear that if you are doing anything as part of restructuring, as part of your normal course of business, obviously you should take that advantage and do it, but it should not be non-compliant or it should not trigger GAR. That is very important. And the second question which the gentleman asked is very important, that if you have, like you mentioned, you have a B2B business and a B2C business and you are doing, let's say, in one entity, does it make sense to take out the B2B business and do it from JAVZA? It will really depend on three most important aspects. One is, who are you supplying to? Are the customers based out of UAE or global? Because let's say JAVZA, there are people who are supplying globally, right? So you have to understand that part. That is very important. Are you supplying to non-free zone persons, which is global people? That is very important. Secondly, do you want to maintain the QFZP status? Because maintaining that status is not that simple. You have to comply a lot because you are falling under 0% bracket. So you have to comply much more compared to 9%, because we will be paying taxes as compared to any free zone entity who provides qualifying income. And third, take an independent advice that yes, the qualifying income what you are taking falls under the definition of the law. This is very important because a lot of people misinterpret the law. They will casually tell you, no, open in a free zone, it will be 0%. It's not like that. There are many criteria that needs to comply with. So we generally avoid giving any advice unless we look at whether you are doing qualifying income and deriving those income from qualifying activity. So this is very important. When you plan, focus on that. So again, if you have three companies, all three companies have common shareholding of 95%, can you form a tax group? Yes or no? Perfect. And if it is 51%? No. This is different than VAT. Corporate tax law is very clear about it. So this is where the question comes. Qualifying group. What do you mean by a qualifying group? We spoke about tax group. Qualifying group is also a very simple example that you have two companies. One company is profit, one company is doing losses. In order to adjust that losses with the profitable company, you are allowed to provide that provision as long as you are a qualifying group. And what is the criteria of a qualifying group? 75% or above common shareholding. So if two companies which has common shareholding of 75% and above, you can fall under qualifying group. I'm just slightly knowing the time, I just want to skip quickly. Tax loss relief, again they have provided up to 75% every year you have of your taxable income of that particular tax period. This is something which is important for you to comply with. Which means what? Suppose in this year 2024 you had a loss and 2025 you had a profit. In order to adjust the loss of this year with the next year profit, up to 75% of the next year profit only you can adjust, or the amount whichever is lower. Transfer of loss, as I explained, qualifying group or tax group, you can easily transfer your losses. That's something very critical and important. I'll just go into the key corporate tax transfer pricing. This is very important. Has your organization or your companies have started working on TP framework, transfer pricing framework? Let's say you gave an example of two entities. Any related party dealings has to be done on benchmark. How many of you are owning your own business? Yes. So have you benchmarked, thank you, have you guys benchmarked your own salary, what you are drawing from your business? This is falling under corporate tax criteria, and you have to start thinking about it, whether you fall under that criteria, and if yes, whether it is benchmark against the industry. If you don't have the industry data, then you have to look at the functional data. So we'll take you through these transfer pricing mechanism also. So this is where corporate tax is very becoming complicated. I'll not spend complicating you, I'll try to simplify it. What it says is that if there are two entities with common shareholding above 51% or common control, the transaction has to go through arm's length principle. Arm's length principle, as long as it goes, which means if I am dealing with a third party, in the same way I should deal with my related party. If that is the criteria I am meeting, I would be complying with the regulation. Looks very simple, but it is very complicated. There are multiple methods to arrive at it, and the regulator would be checking up on it. So it's very important you start working on your framework. What are the dealings you have with your related party? Does it mean that related party in UAE only will fall under transfer pricing? Suppose you have a group entity in India or KSA or Canada. Any related party transaction with that also will fall under transfer pricing? Perfect, it will fall under that. So related party means that all the declaration of that particular shareholder or the entity which owns multiple companies, transfer pricing mechanism will be important. The cycle is very simple. Identify all your related party, do a functional analysis, what is the basics of it, do an economic analysis, and compute your benchmarking exercise. There are multiple methods which we have given. For example, associated person, who are these associated person? Let me just go into that. One important criteria which has been there is, people think that transfer pricing may not apply to you because the turnover threshold which has been given is 200 million dirham. Let me clarify this point. 200 million dirham is for the TP compliance, is what we call maintaining of the local file and master file. It has nothing to do with the arm's length principle. Arm's length principle applies on all transaction with your related party, and the authorities have the right to question it in case they find that it is not in line with the requirement. So this is how we define the related party, either based on your natural person. One of the most important thing is they have given that 4th degree of kingship, which means great-great-grandfather, any related party, they have defined as part of that. Now, does it mean that it may be applicable to you or not? That you have to assess, but still, these are the criteria which they have given. But anywhere above 50% control, voting rights or shares, this will form part of your overall assessment whether TP application applies between the parties or not. Connected persons also, like I mentioned, some of you, that if you are a director or if you are a CEO and you are also a shareholder, you by virtue of owning shares are connected, and as part of that you have to start doing your benchmarking. If you are maintaining documentation, great. If you are not, start doing these forms. These are mandatory irrespective of the requirement. You have to have the disclosure form, master file and local file. If you maintain the 200 million turnover and above benchmark, you have to start doing it. In Saudi, they gave a lower benchmark, but here it is much higher. So this is something which I just thought may be useful for your audience, that third-party salary data, if you are not available when you are benchmarking as a MD or a CEO, and you are also a shareholder in the company, if you don't have third-party data, then transfer pricing method would be other method where arm's length principle would be based on third-party benchmark data or whichever is your salary, whichever is lower. Plus minus 10% from the benchmark data is fine, but if you don't have that particular data, then you have to go into the second part where you have to see your industry, the profitability, whether the profitability is coming from the, so suppose my overall profit is 1 million and I am drawing 1.2 million and ultimately my losses are 200,000. So you will be questioned why this is there. So in order to justify, there is another method logic which has been given where you have to justify based on the function that you are actively involved, this is the requirement, this is the benchmark, these are the things. Those documentation has to be done in thorough. So reselling of product without value addition. Another scenario, what do you mean by reselling of product? This is something very important for all of you to understand, because a lot of you would be into import-export also. So if you are buying and just distributing and reselling it to another third party, as part of that, transfer pricing mechanism will apply, will not apply? Will apply. So as we said, any transaction with related party, it will apply. So what you have to do is, you have to use net margin of comparable companies and determine whether you are focusing or whether you are providing. Let's say if you are in textile industry, 5 to 10% is the net margin. You put value addition over and above what the cost price is. If it is gold, it will be different. If it is a normal trading or minerals, depending on that your industry. There are benchmark data websites which are there. There are also data which you can provide from experts like us. We would be able to help you out on that. This is another good example. Suppose you have a free zone entity and a mainland entity. There are two scenarios that will develop in transfer pricing. If you are a qualifying free zone or if you are a non-qualifying free zone. If you are a qualifying free zone entity, you will be taxed at 0 rate, right? So if a good which I should have sold to you at 100, I sold to you at 150, which means my expense in the LLC becomes higher, which means my profit goes down, while my profit is higher in the QFZP, where I am paying 0 rated, and in the LLC I am paying less profit at 9%. If this happens, there would be a method where tax authority will come and say, no, this is not as per benchmark. They will increase your cost. They will take that additional, let's say instead of 150, you sold at 50. So that 50, if they come to know, they will tax you at the rate 9%. Now that tax is an expense to QFZP because you cannot claim it back. But if you are a non-QFZP, if you disallow an income with a related party on one side, the tax authority have told you that you can also disallow that particular income on this side also. So which means what? You don't need to pay double taxation as part of that. So this is how, I mean, the requirement summary that you all have to follow, which is important for all of you when you do your assessment, when you do your implementation. It goes into starting from taxable person, qualifying free zone, tax applicability, when is the registration deadline. All these requirements will be important for you. And as part of this, there are certain FAQs which I highly recommend. If you want more clarification, you can go on FTA website. They have provided you that. And if further queries and anything is there through NBF, we are more than happy to provide you clarification as part of that. With this, I would like to end my session, and I would like once again to thank you for so much engagement during the discussion. Thank you so much, all of you.
Before we move into our panel discussion, I would like to invite Mr. Ken Broadley, Managing Partner, Living Business, who will provide a quick brief about the sustainability project where NBF is collaborating with Living Business. Please come, Mr. Ken.
Thank you. Thank you very much. We started this morning hearing about a topic which is rather imprecise and uncertain, the topic of economics. We then moved on to a topic which is much more precise and unfortunately very certain, UAE taxation. I'm now going to delve into it or talk briefly about another rather imprecise topic, and that is ESG. Environment, social governance. I'm sure you've all heard of it or read about it in the press, online. It's actually a very imprecise topic because you take three rather imprecise subjects, which are sort of environmental sustainability, social sustainability, and governance, and lump them together in ESG, and you get something which is really rather vague and hard to get your hands around. But it is a very, well, actually, can I see a show of hands? Can I see a show of hands from people in the audience who think that ESG will have a bigger impact on their business in the next 10 years than it has in the last? Who expects ESG to have a bigger impact on their business the next 10 years than the last? Just raise your hands. Okay. Keep your hands up if you believe that your business should be doing more about ESG in the next couple of years than it is at the moment. Okay, there's a good number of hands up. Well, you're the guys I'm here to talk to, really. The rest of the audience, you can take your phones out or whatever. But I personally believe that ESG is going to become a lot more important for businesses. It's a concept that was started by investors, and then financial regulators got involved, including the London Stock Exchange, for example. Financial regulators got involved, governments are getting involved. The EU is putting, well, they've now mandated that even medium-sized companies, large companies in the EU, have to start reporting on their ESG performance from 2025 onwards. And also, trading partners are becoming a lot more interested in it. We see a lot of companies in this region who are asking their buyers and suppliers about their ESG credentials, about what they're doing in the world of ESG. I should introduce myself, actually. My name is Keith Bradley, and I'm here representing a program called Living Business, which we run in partnership with NBF. NBF are very generously offering a small number of customers the opportunities to participate in the program. So I just want to take 5 minutes to tell you a little bit about the program. It's a program that's designed to help businesses accelerate their ESG journey. So for those of you who still had their hands up after my 2 questions, this could be an ideal opportunity for you to participate in the program this year. The program, what we do is we look at where you are. So first, very important, the program is bespoke. We work one-on-one. I'm very well aware, I've worked with corporates all my career. Every company is different. Where you are on your ESG journey will be different from your neighbors. Where you want to get to this year on your ESG journey will be different from your neighbors. So we tailor the program for you on a one-on-one basis. So it's not we're not going to sit in lots of workshops or anything like that. It's one-on-one. We work with you to help you achieve what you want to in the space of ESG. We start by looking at where you are, and we then start drawing a roadmap up with you. We make some suggestions as to where we think you could do more, and then we work with you to build a roadmap for how you decide which areas you want to focus on as a corporate, and we then handhold you through the process of getting those things started or accelerated. The program will run for the 2024 cohort will run for the rest of 2024, so we have 9 months now to get some projects off the ground and accelerate ESG in your business. The good news is that thanks to NBF support, there is no cost to being part of the program. We have experts. I mean, I've spent all my life working on corporate governance in different spheres, on corporate strategy. We have experts who can talk about reporting, GRI, ISO certifications, B Corp. We also reach outside our own organization to pull in partners if you're looking for support in things like energy. How do you reduce your energy bills? How do you recycle more water, recycle more waste? All of these things are things we've got a lot of experience of in the UAE. We're based in the UAE. We've worked with about 500 companies in the UAE across different industries. So this is really a fabulous opportunity that NBF are providing for a small number of companies to go through the program in 2024. Together with you, we develop a bespoke plan. We use our expertise to maybe help develop your internal capabilities. I mean, this is very much about developing your internal capabilities so you can take this forward yourselves. But that's the program. If you would like to know more, you really have 2 choices. You can talk to your NBF RM, who I'm sure will be very happy to guide you. Or if you want to do things more directly, since we're face-to-face right now, myself and my colleague Nia will be here after this session and over lunch. We have a stand at the back there, so we'll go and stand by the stand there. It's got a big Living Business banner on it. You can find us there, and we can get you, do the preliminary registration today even, if you like. Though that's Living Business, please give it your consideration. There are only a limited number of places available, and above all, we do want to get this started quickly this year so that you and we have the maximum opportunity to make a real impact. Thank you.
Thank you, Mr. Keith. We will now move into our panel discussion of today, and the topic is key considerations on the UAE corporate tax law, where we will discuss the implications of the corporate tax on the UAE businesses and what are the necessary adjustments and updates should the companies to make sure a smooth transition to the UAE new taxation system. I would now like to invite Mr. James Falconey, Director LSEG, who will be moderating the panel. James is an account director at the London Stock Exchange Group. James began his presenting and video career as the face of Thomson Reuters back in 2015. After successfully delivering multiple interviews and videos with C-level officials, James began hosting major events and ceremonies. I would also invite on the stage our panelists, Charles Collett, Partner Tax, PwC Dubai, Dana Pillai, Founder, DP Taxation Consultancy, Sharma Afalahi, Partner, Head of Tax, BSA, Ahmad bin Hazim, and Associates. Please welcome.
Thank you very much. First and foremost, I want to say thank you to the National Bank of Fujairah for arranging these knowledge series. They're extremely insightful, they're extremely informative, so thank you very much to the National Bank of Fujairah. Thank you to my wonderful, esteemed panelists. I'm looking forward to picking your brains along with the audience. But most importantly, and thirdly, thank you very much to each and every one of you, the most important person, the customer. We thank you for your business, we appreciate your custom, and on behalf of the National Bank of Fujairah, we thank you dearly, so thanks. You have pens and papers in front of you, and I urge you to use them, please. Write down your questions, be inquisitive, and pick the brains of our experts, because this is a very, very informative and very topical theme. So I do urge you to write questions down, and the first person who asks a question even gets 10 points. So even more reason to ask your questions. But if you don't want to ask questions, then outside we have lunch. You heard from Keith, you can network, but share open ideas, speak to each other, network, and more importantly, build relationships, because in this digital and AI world that we live in, human interaction is a little bit less common these days. So with that being said, panelists, can you please do me the honor of introducing yourselves? A quick 2 minutes, who you are and what you do, starting with yourself, Dana.
Good morning, everyone. Thanks, James. My name is Dana Pillai. I'm founder and manager at DP Taxation. I've done my tax consulting for 19 years. I studied in the Netherlands. By background, I'm a lawyer. I'm not a chartered accountant. So traditionally, lawyers were doing tax advisory and compliance. So I take the proud moment of being part of this panel and going to answer your questions. My journey is from Netherlands. I started there because I studied there under International Tax Center. I'm not sure how many of you know about that institution. It's quite a well-known institution for international tax law. It's like sort of, they say, they're famous exporters, tax lawyers. And after that, I was in Oman for 13 years and now in the UAE. My last held position was Group Head of Tax of Yas Holding. Thank you.
So hi everyone, I'm Charles Collett. I'm one of the partners helping to lead PwC's UAE corporate tax practice. So I often joke that I didn't exist. You know, just over a year ago, there was no such thing as a UAE corporate tax partner. But obviously now we're living in a new reality. I think, you know, in reality, I've actually been practicing corporate tax across the globe for nearly 20 years now in various places. So started my career in the UK, spent a long time in Singapore, a few years in the US. So try and share some of the kind of perspectives on how we've seen other regimes evolve and kind of what that means for us in the UAE.
Good morning, everyone. Shamal Falahi. I am a head tax partner at BSA Ahmed bin Hazim. Prior to joining BSA, which is a law firm that is headquartered at the IFC for the last 20 years, we do have our offices in Oman, Saudi, and across the region. Prior to that, I was part of the Federal Tax Authority. So I joined them since the implementation of tax in the UAE back in 2018-19. I used to head the tax returns and payment section. That's the main section that led all operations, let it be voluntary disclosure, returns, refunds, all of that. Been there, done that. I can tell you the inside information that you need to do. I moved to BSA recently in October. I am currently the head of tax, the tax partner there. Thank you.
Thank you, Shama. UAE corporate tax, the evolving business landscape, hot topic, and I'm going to start with yourself, Charles. So what impact is the UAE corporate tax going to be having on the profitability on UAE businesses? And more importantly, how could that impact be minimized?
Yeah, okay. I mean, the simple answer to that is obviously 9%. I mean, if you were previously, earning profits of 100, you are going to pay up those profits to shareholders. Going forwards, you would now be paying up, 91 of profits. I mean, the how much is at stake is relatively straightforward question. Now, I think as some of the other sessions touched upon, it's not quite that straightforward. It might not be precisely 9, could be slightly more, could be slightly less. We'll touch on free zones, and obviously free zones have been discussed. But, broadly, for a lot of normal businesses, we're talking about a 9% impact on your after-tax profits going to shareholders. Now, as you said, I think the more interesting question is, what do we do about that? And, I think there's been a lot of there's been an emotional roller coaster that people have gone through in terms of, this isn't happening, acceptance that this is happening, got through the denial phase and into the acceptance. But now, what do we do pragmatically? I think in reality, there's only a handful of things we can realistically do. So one is consider, do we want to be somewhere else? I mean, that's, an honest question. The UAE government won't thank me for asking that question, but I think clearly that's something people need to consider. I think the reality is the significant majority of businesses are here because they want to do business in the UAE. So it's not realistic to consider, we still have clients ask us, can we move to Cayman? Can we just, shift intellectual property to Cayman? Can we go to BVI or some other tax haven? There may be some opportunities around the edges to do some of that kind of planning, but realistically, if you need to do business in the UAE, your substance is here, your customers are here, then your opportunities to leave the UAE are pretty limited. So putting that aside, what do we do? And I think we're now in the phase that, pretty much every other jurisdiction around the world is in, which is we need to understand the law well. We need to understand how it applies to us. We need to understand where the opportunities are within the law to be a respectful taxpayer, but to mitigate our tax charge with fair tax planning. And I think the big opportunities here in the UAE are around the free zone. I think there's opportunities around using debt, so taking interest deductions, which is a common planning elsewhere. There's other opportunities around your financial policies, your accounting policies and how you account for certain items. And those are the typical tools you see elsewhere in the world. So for those of you familiar with other regimes, again, we're pulling similar levers to see whether we can mitigate our overall tax. Now, I would just say one more thing. I know this is meant to be a panel discussion, not a presentation, so I'll stop talking. But thinking about your tax profile on a regional or global basis is actually how you'll likely move the needle. If we're just looking at our UAE profile, what can we do to reduce UAE tax? There's limited opportunities. If we look at how we interact with our GCC related parties, our global related parties, there may be more opportunity there to reduce the overall impact of the tax.
Thank you, Charles. You mentioned free zone companies, so Shama, I'd love to bring you in now because the recent changes in the UAE tax law, November 2023, how will that affect free zone companies?
When the law came out, I remember free zones were the ones on their toes because everyone who started a company in the free zone, there was a promise that it's a tax-free or zero tax designated zone. So when the law came out, I know companies operating in such a restriction had to change the their structures, their operation, and so on. But if a company that was established in a free zone was actually operating as a free zone entity, the impact wouldn't actually be there. Funny thing, we usually in the office have something called Beyond the Bar, where we discuss things, are you with or against? Is it fair that 0% or 9% are being imposed on free zones? And that's the never-ending debate. But as Charles just mentioned, it's there and we need to accept it. Finding ways to work around it would be the solution. I was here for the presentation just before us by Dr. Abi Sheikh, and he covered all the aspects of qualifying free zone person and how to meet those criteria to be one. Because the information that if I speak to anyone that had a company operating in free zone, they would tell me, no, we're not taxed, we don't need to register. And no, you would need to register. You would need to make sure that you fit those criteria and maintain that, because if you fail to do so, you will be taxed for the next 4 years. So companies operating in free zone need to be a bit careful on how do they read and understand the law, because it's a bit tricky. So I would say that's how it would reshape, because discussion or debates before, do I set a company a free zone or mainland, that was clear. Set it up in free zone. But now everyone would need to rethink that, I'd say. Yeah.
Would you agree that substance is also the kind of critical part of this?
Yes.
I mean, for those who are not in free zones, thinking, we'll set up an office in the free zone and try and take advantage of 0%, in reality, that may be tricky unless you're willing to push, the majority of your business substance into the free zone, right?
Yes, exactly. And that's what I said. Prior to corporate tax being implemented, it was a much easier discussion because there were no criteria that you need to meet, adequate substance being one of them. So now companies would need to sit down and really have a full plan, as you said, and not only look at the UAE, as you said, the full globe. Where are you operating and who are your end users? Is it a business or consumer?
Thank you, Shamba. You've used the word fair and tricky, so Dana, I would love to bring you in now, because to what extent, in a fair way, can the business owners here listening to this discussion, how can they reconstruct, or how could they, from an operational point of view, do some rejigging and changes to make the UAE corporate tax, to optimize it from that standpoint?
Yeah, so that sort of brings us to the question of some sort of a tax planning opportunities that would have been available to the companies in the last year. And as Shama said, that the sort of the perspective of the qualified free zone was that there's not going to be any taxation at all for the free zone companies as long as they were registered in the free zones. So there were many companies who were still having operations that were interlinking with the mainland. So they were. So I have a very practical example. That there was a client who approached me for the. So there is a qualified free zone company which can actually qualify for this status, and they have a mainland company, but operationally they are so interlinked. For the VAT purposes, they are a tax group, they are a VAT group. But because for the VAT, the qualification is only above 50%, but then for the corporate tax, it is above 95%. They were not able to do a tax group even if they would benefit by tax group leaving out this qualified free zone opportunity at all. Now we are in a situation where we are having to decide. So it is not just, okay, it's a free zone company, I qualify as a qualified free zone company, so I go and register it as a qualified free zone company and I pay 0 rated. It's not like that, because we need to see holistically. What we are talking about here is an effective tax rate for the ultimate shareholders. And so, because it's affecting the profitability of the dividend, what you will distribute in the end. So it's not like individual entities. In the case of this client, there's a lot of intercompany transactions which will attract RPT, TP disclosures, irrespective of that, because it's a QVZB, because they are having to elect that now. They actually miss this opportunity of restructuring it now, because if they would restructure, then we have to give some kind of a reason that it is being done in the ordinary course of business. So to come to your question, James, that is, there's a lot of tax planning opportunities that would have been there in the last year. maybe this year also, because of that we could make a valid justification for logistic reasons, administrative reason that we want to do something like this, we can think about not just going by the definition of qualified free zone, because the minute you elect qualified free zone, you're having to put your income in 2 boxes, excluded or qualified, and they are not mutually exclusive because there is something in between that is non-qualifying. So what that will happen, that is not going to have any threshold. It's going to be taxed at 9%. Now, when we talk about the tax planning opportunities, you could see this holistic approach for your entire business group. You can see the administrative cumbersomeness, because you're not having to have a VAT group that is completely different from the tax group. And also, what about the consolidation of the financial statements? If you have a group of more than 10 companies, this is, you are going to have a consolidation for the 10 companies for your accounting purposes, and then you're going to have another consolidation for the tax group entities. Now, when we talk about tax, it's not just about the tax efficiency rate. It's also about how to manage taxes effectively, cost-effectively. So this is one way of looking at it, that is, you can have a holistic approach to your companies. Chart of accounts is another area where you should focus when it comes to the adjustments also, like, for example, your entertainment expenditure, that's going to be 50% disallowed. So you could separate that expenses separate from the, if they are booked together with the travel expenses, which can be still allowed, then you could separate the entertainment expenditure, which is like 50% allowed. Again, some companies had the opportunity to do the financing arrangements before. Now the opportunity is lost, but still, we could still look at some of the financing arrangement, whether it can be rearranged. Those are some of the, there's plenty of ways how we can do it, but then what we have to keep in mind is that it should not lead to uncertain tax situation. The minute it is uncertain, then you're having to create tax provisions. And then until the tax assessment comes through, we are not going to be sure about what you have filed. So one of the questions this morning was about the high sea sale. That's again an area where you have to be extremely careful about. You need to have a proper advice on that area. People are quickly planning things for the high sea sale. That's another going to lead to tax uncertainty. And also your foreign companies. So if you are going to have operation outside of the country, you know that we have these 3 kinds of taxpayers, which is the resident companies, which is like the worldwide taxation. And then you have the individuals, and then you have the foreign companies operating here, and then you are operating outside. Now, if under the tax law, you're allowed to elect either to exempt that income or to take foreign tax credit if you are able to have a PE, if you are able to show that you have a PE outside of the country. That's another way of looking at how you can plan if you especially have tax treaty with that other country. So there's opportunities like that. Right. There was a question on, Abhishek quoted a China example. That could be a very good example for tax planning. So this I think you need to look at the concepts under the tax law, the participation exemptions, where they have spoken about the capital gains, because UAE tax law is very consciously allowing avoidance of economic double taxation and juridical double taxation. That's where you need to sort of take advantage, because we don't know how many years that's going to be. There is 0% withholding tax. So, like if you are distributing dividends even to the foreigners, foreign shareholders, there's still not going to be any dividend withholding tax in the UAE.
Quite a lot indeed. Again, to keep it flowing, because I would love to continue, but I know that we're a bit short on time. Charles, what income is tax-free under the UAE tax law? What income is free of tax?
Well, I guess the good news for everyone in this room is that personal investment income is not subject to UAE corporate tax. Exactly. So, you know, if you own properties, you own shares, it's been very well clarified that, you know, provided that's not part of a business activity, you know, you're not going to be subject to tax. So we very often still regularly get the question, is personal tax coming, or, you know, we personally going to be subject to tax? I mean, I am not a policy maker. Look, obviously this is about corporate tax, so I don't want to get sidetracked on that, but I think at this point, we haven't seen any indication that personal tax is coming in the short term, right? So fingers crossed, we all hope it doesn't. Back to the corporate tax side, so I think some of the sessions earlier already touched upon the slightly surprisingly, the UAE regime is a worldwide taxation regime. You know, if you look at some other territories around the world that have tried to play a similar role to the UAE, of being, you know, a hub jurisdiction to attract lots of FDI, some of them have taken the decision to be a territorial regime only, which means broadly that your foreign income would just be not subject to tax. Some of us were slightly surprised the UAE went down the route of saying your foreign income, so foreign dividends, gains on foreign shares, foreign branch profits, all prima facie subject to tax. However, they brought in a very broadly applicable participation exemption, which means in most cases, your foreign income will not be subject to tax. However, you still have to go through many hoops. There's a lot of data collection required to prove that you can take advantage of the participation exemption. There will be instances where it just doesn't apply. So foreign income broadly exempt. Dividends from domestic companies also exempt. So, you know, you can circulate cash in a UAE group with no real challenge. And then there's some sector-specific entity exemptions for things like the oil and gas and extractive types of industries. But other than that, most income, unfortunately, fortunately not the personal income, but will be subject to UAE CT.
Very interesting. And again, don't forget that we're going to have lunch after, so please pick the brains of the experts if you want to divulge and delve a bit deeper. Shama, to bring you in, corporate tax, explain how that's going to be affecting SMEs and divulge a little bit more about small business relief, please.
SMEs has been a key pillar in the UAE government vision of advancing economy in the UAE. So when the corporate tax law came out, there was a small business relief, and that's just to support more businesses. We are, the country is a country that would want new investors. I was just in Investopia last week, where a lot of new enterprises are starting in businesses. So smart business relief is there for entities that are resident. Again, non-resident cannot benefit from that. That do have a revenue that is up to or less than 3 million per year, and they have to elect on every tax period. Yet qualifying free-zone person cannot benefit from that again, and MNCs as well. So it is there to help businesses or SMEs survive this tax environment or landscape.
Survive.
9% is still way lower than other countries. Yeah. So yeah, that's SME, that's the small business reliefs that if anyone here fits those criteria, you would again need to elect for that. Nothing would be just given to a taxable person. They will be treated, any income that is derived will be treated as a non-taxable income, so no tax would be applicable at that if they meet those criteria of maintaining a revenue of less than 3 million.
Okay, which is good news. So again, reach out to Shama when it comes to small business relief queries. I'm going to open up to the crowd, so please get prepared with your questions. But Dana, the word survive this corporate tax era, it's ongoing, it's ever evolving. So if I'm in the crowd, I'll be asking myself, as a business owner, what adjustments could I be making to ensure a smooth transition?
I mean, so we don't pay tax on the accounting income, we pay on the taxable income. So in any country, there's what we call as the book to tax differences. And so there's like the corporate tax guide, very detailed, deals with this, how to arrive at the taxable income. So when we talk about the accounting income, obviously the standard here is IFRS. First of all, the accounting income must be arrived at applying these standards. And they say that below 50 million top line is, you can follow the IFRS for the SME. So before I answer that question of tax adjustments, how we clarified, Abhishek was clarifying this morning that everybody have to register for corporate taxation. It's also that everybody have to maintain accounts. Even that was missing. Even since 2018, VAT is in the UAE, but there are so many companies which doesn't maintain proper accounts, or even audited financials. It's not very compulsory under this corporate tax. But for free zones, if they are electing to be qualified free zone, all the qualified free zone companies have to do auditing. So that's like a must. So to start with is accounting income. So that must be also like adhered to. Tax law is already saying how an accounting income must be arrived. And then from there, we are going to start making the add and the less and to arrive at the taxable income. Charles touched upon the exempt income. That's one of the difference, the book to tax difference. Because when we talk about book to tax difference, you all know there's going to be some permanent differences and some temporary differences. When we say temporary differences, it means that it is going to get rectified in one of the future years, either positively or negatively. So you might be either paying more tax than what you should in comparison with your accounting income, and then later on you get it adjusted in the sense that you pay less, which is like the deferred tax asset, what we call as, and then the other just vice versa is called as a deferred tax liability. So you can imagine the many jurisdictions, like commonly about the unrealized currency gains and losses. Not just that, even against assets and liabilities itself. The UAE law is saying that, tax law is saying that, please elect. First year is your opportunity to elect. And then they say maintain a consistency. Whether you want to, so it's always like with the tax authority, it's like give and take, right? Like, okay, so you say that you will not, pay tax on the unrealized income, then I'm not going to give you the unrealized, losses to be deducted. So but this is something that you can arrive at because it's all election. You must be, of course, doing a simulation already, like, into the years what will benefit you. That could be one of the, it looks like a temporary difference, but then it might make a huge impact on your profitability given that the net present value of money. And then like exempt income is obviously a permanent difference. When we say exempt income, then again we are talking about the corollary, right? Because there's always business expenses attached with how you derive an exempt income. Then if you are not going to pay tax on the exempt income, then you can also not claim deduction of those expenses. Now, again, we don't want to go into detail now how we are going to proportionate that if it's combined with if the income, the regular income where you pay subject to tax is derived from. So, and then the general interest expenditure. So, you know that only 30% of EBITDA is going to be allowed. So that's the 70% is a permanent difference. And you also have the related party financing arrangements. That the UAE tax law is a little bit stubborn about that, and that's going to be a sort of a permanent difference for you. So obviously that we have to be making a lot of adjustments. These are quite the main ones, you can say. Entertainment expense, which we already spoke about, 50% is only allowed for deductions, so the rest of it is going to be your permanent differences. Your tax loss carry forward, that is also it's an adjustment, I would say, but that's actually against your taxable, the actual tax that you pay, but that's just towards the end. Still, how much you can carry forward is also limited. You can't carry back. For the first year, you're not going to be able to bring any tax loss forward. So it's like a fresh year for everybody, although you're going to bring all your opening balances into this, the starting of the first tax year.
Right.
I mean, you can always ask some specific items of income or an expense, like grants and all of that. I'm not sure how many, it's relevant for how many people, but there's like a lots of income and expenditure that we can talk about, how this tax law is going to, like UASB provisions, credit loss.
There's obviously quite a lot there.
Yeah.
Understood, thank you. Now's the time to speak to the most important person, and I see a hand already raised there, so 10 points for you, sir. Yes, please. I don't know, do we have a microphone, please? So now's the time, people, to please pick the brains of the experts and start some open dialogue.
So I have a question for Charles. Charles, under the FTA framework provided for corporate tax, still not adequate guidance has been provided for offshore companies. Now, I went to the JAVSA regulations for the offshore companies. So one of the articles says that they have the capacity of natural persons. I think Article 8 of the regulations. And then there's another Article 14 which says they can do 7 activities. Only one of them is like holding of shares and another one holding of properties. Now, quite a few, and many of us sitting here would relate to it because they would have offshore companies here in UAE which hold investment properties. And they are even taking rentals of that, and they are receiving dividends of the companies in which they have held shares. That is not specified in the regulations. So chances are they are in contravention of those regulations. Now, the taxation of offshore companies, FTA has not provided guidance. Yep. We've heard PwC say that probably they will be treated as non-resident persons. I would request you to shed some feedback on that so that we know how to do the taxation of offshore companies.
Yeah, so I think it's pretty clear the law, as you pointed out, doesn't make a distinction between offshore and onshore, if you want to call the rest onshore. And our view is that's because they treat offshore companies exactly the same as any other company that's incorporated in the UAE. So although we have this offshore regime, it's really a special type of arrangement. That doesn't mean that it isn't viewed as a resident UAE company and that it is a UAE juridical person. Now, we've had this conversation with many, and I think there are some who have moved towards acceptance that an offshore company is just going to be treated the same as any other UAE company. There are others who I think are struggling with this, and actually for some of the same reasons that you point out, that there are indications in the kind of constitution of an offshore company that could imply otherwise. Part of the reason our view as a firm is that they should not be differentiated is because the law did not differentiate them. And it was very clear that offshore companies existed, and if the law wanted to make a distinction, that it could have done this. It doesn't seem like it's an omission, an accidental omission. It was very clearly something that could have been addressed if they intended for there to be a different treatment. So I'm afraid to say at this point in time, absent anything else coming out, our view is they will be treated as resident juridical companies subject to UAE corporate tax. Now, obviously, if the management and control of that entity is offshore, then it could be viewed as non-resident, but prima facie, we would view offshore the same as onshore, I'm afraid. Okay.
Great question, thank you. And I urge you to reach out to Charles during the lunchtime break. Anyone else? Yes, sir.
I've got a quick question while the mic's moving. What do they get for their points? You said 10 points?
The points?
Yeah.
Yes, 10 points. They'll be dished out at lunchtime, okay? So you, sir, are getting 10 points. Hello.
As such, Dana had touched base upon the double tax avoidance. Now, if there is a treaty with some of the countries, so if there is a contradiction between the corporate tax law and the DTAA, with that perspective for the transaction with under that country, so what would prevail in that case? Secondly, another question, and if you are doing all this tax planning or whatever it is, so how much is the subjectivity involved so that we don't get into the violation of GAR?
So that's two questions,
Two
so 20
questions.
points. Okay, so thanks for that question, first of all. So I can, first of all, let me explain how tax treaty first it must be applied. So tax treaty is actually sitting on the national law. So when we, for example, if the local law, that is UAE law, now it says 0% of withholding tax. And tax treaty is saying 10%, I mean, because the tax treaty, can everybody hear me?
Yeah,
okay,
you're
right.
fine.
Now there is, when tax treaty is entered, say for instance, other countries having withholding tax of 15% on the technical services and 0% on the side of UAE. But before corporate tax was there, still tax treaty was there for UAE. Why the tax treaty was there, it's just for the other country to apply. So what tax treaty basically does is it limits the national law. But if the national law is already limited, you don't apply the tax treaty. It doesn't come into the picture. So the way to apply tax treaty is you go through the Article 1, and then you have the Article 2 of the tax treaty, and then you have to apply accordingly. So you must select as a person and whether that tax is covered, etc. And then you move on to the other articles. So to answer your question of contradiction, there's never going to be a conflict between the tax treaty and the local law. We first have to decide the taxation or what's the taxability of that particular source of income or the payment based on the source country. So if the income sources from the UAE and if the other country, that's a host country, the host country is, for example, Kazakhstan, for example. So that's the host country where the actual resident is living and then he is receiving the payment from UAE. So as source country, UAE has a right to withhold the tax before distributing the payment to the resident in the host country, and the right would be of the obligation would be of the person who is actually paying the money. That is how first we have to see what is the taxability on that income is going to be. And while applying that, what will happen? There is a local law here which is saying that there is going to be a 10% source taxation, and then the host country will say, no, I will tax it at whatever income because it's a corporate tax income or something. Now what you see is called as a double taxation in two different countries. That is juridical double taxation. To avoid that, we have a tax treaty which is DTAA, Double Taxation Avoidance Agreement. So the purpose of tax treaty is to avoid this double taxation, but in many cases there's been double dipping where the tax treaty is been abusively used where there is double non-taxation. So you don't pay tax there, you don't pay tax here, you just basically start applying. But there's been a lot of lobbying and there's been like so many amendments to with the multilateral treaty and all of that. So there cannot be a conflict, number one. First we have to see the local jurisdiction, how it applies, and we don't even have to worry about the host country. You can apply the tax treaty based just on the source country, whether it is limiting. If so, tax treaty is not limiting, then you just go by what is the local country, that's what it says. When we talk about tax planning, the aggressive tax planning.
Maybe before we go from that question, because the CT law specifically says that if there is a conflict between the treaty and the domestic law, that actually the treaty will take precedent. So I think it's very clear under the law that if there is a conflict, I agree that generally you wouldn't expect a contradiction, but if there is any, in theory, the treaty takes precedent. I think the challenge with that is more a practical one, that you're going to have to go for mutual authority procedures to say you view it this way, one territory, you view it that way, and your chances of getting them to agree. That's typically the challenge with trying to say we have a conflict under the treaty and we want to try and apply the treaty.
Over there, I would just say the conflict might be just the way how we interpret the local law against the tax treaty. In principle, this is how it is. When we talk about aggressive tax planning, which is caught by the GAR, where they clearly say that we don't want to allow any anti-abuse provision, just so you don't do any restructuring only for the sake of achieving the taxation
Dana,
benefits.
if you don't mind as well, maybe we can take it offline because I know that I'm literally short on time here, I'm afraid. We've literally only got 5 minutes. So please, very pertinent question, sir, and maybe take that one offline if you don't mind. Other hands in the air on different subjects. I can see there's about 3 hands in the air. I'm sorry, the person behind you with the glasses. A very pertinent question. Thank you very much, though, sir.
Yes. Thank you. My question is to Shama. I have a question on flexi desks operating out of JAFSA. So would they fall under the small, medium-sized relief
So
from tax?
it's operating in JAFSA?
JAFSA, out of a flexi desk. So flexi desk offices.
I assume you're going to elect not to be a qualifying free zone person because a flexi desk could not fit the criteria of adequate substance.
Yeah.
Then you'll have to elect to be taxable. And then when a person, that's one point that we haven't touched upon, that a qualifying free zone person can elect to be taxable and then benefit from all the reliefs that are available in the law, whether it's small business reliefs or qualifying groups, all of those other things that are there. So the answer would be yes, but we can discuss that more.
Okay. Thank you.
As long as you're not, your revenue is not higher than 3 million.
Yes.
Thank you.
Thank you very much.
Thank you very much, Shama. Apologies again to know that we're short on time. Sorry, panelists. Anything supplementary to that?
No, I'm going to let you keep things moving.
Thank you.
No.
I saw a hand at the air. If we can have a microphone for the gentleman at the front, please.
Just a quick question to Charles. Now we have updated deadline for Pillar 2 in the UAE, and I believe that for Pillar 2 implementation, Middle East is the most diverse region having low tax, no taxes, and we have corporate tax in place in UAE. How multinational enterprises would prepare themselves, both, coming this new reforms, Pillar 2, along with the corporate tax. So would there be a lot of restructuring would take place in the region? So how do you take this is this a new opportunities for the multinational enterprise, or there would be a lot of challenges as well?
Yeah, it's a really good question because we very often spend a lot of time talking about how we mitigate the 9% tax and how do we get into free zones, how do we do this and that, and then with many of our clients we figure out, well, actually you're going to be subject to Pillar 2, so is it really worth you shifting your entire business into a free zone? There's no doubt that Pillar 2 is going to be a huge impact, and the fact that it's pretty much written into law that we will have it now in UAE is huge. The fact that it will be rolled out across the globe means it's pretty difficult to structure out of. I think you said, what are people doing? Are they considering how do they get out of it? It's been deliberately designed in such a way that it is very, very difficult to kind of get out of Pillar 2. Now, there's a common misconception that if you're in Pillar 2, effectively you'll take your profits and then you just apply a 15% tax to them. So it will no longer be the 9% that we've been talking about, you just swap that out for 15. That's not actually mechanically how Pillar 2 works. We think, and we still don't know for the UAE, but how it works elsewhere, you calculate your domestic tax based on the domestic law, then you have a separate calculation of your Pillar 2 taxable profits. And they will be different from your corporate tax domestic profits. The relevance of that being, in most cases, most businesses won't end up paying 15% effective tax rate. And so what this means is it's still worthwhile for us to consider how do we kind of mitigate and manage UAE tax, even if we know we're going to be in Pillar 2. It's still worthwhile thinking maybe I will get in a free zone. The biggest area for me of impact of Pillar 2 is actually not the 15% tax rate. It is how you comply with it. We're looking at helping clients to how do we collect the data for Pillar 2 already, because it's going to be such a big exercise that they're already starting to get prepared a year before. We've estimated there's something around 350 data points that you need for Pillar 2 that you don't require for corporate tax and don't really require for any other business purposes. Now, identifying those, tracking those, making sure your ERP is sensitized. Many of those won't come from your ERP, they're from the legal team, they're from others, so complying with Pillar 2 is going to be a huge operational exercise. So I encourage you, if you fall into that bucket, to start thinking about that early.
Dana, anything from yourself, Dana?
Just 2 points to what Charles said. First of all, it will be introduced with safe harbor rules, so you will have some period to prepare for it. And also, if you're talking about Pillar 2, you're already complying with CBCR, I think. So it's going to be an extended data model, but the data points are really serious. Like there's so many information that you have to get from the financials as well as the external other inputs. Like if you're using some tax solutions already, you might be like familiar with how these data points should flow into your reporting system. So that's also like, yeah, something to look into.
Thank you. There was a hand in the air, and also to the left, I'm very conscious that everyone on the left, so you'll be coming up next, sir. Yes, please. A microphone, please. Sorry, if there's a microphone for the rest of the audience to hear. And I've been told I've got a bit more time, so sorry for rushing everyone. I think I've got a bit more time, yeah? Good stuff.
So my question is on digital nexus. So up till now, only one decision has given some indication that holding of an immovable property would be seen as a nexus. But not much debate has happened on how digital nexus will be taxed in UAE. Some technology companies I was speaking to, and they have, their clientele is even out of UAE quite a lot, and new developments, UAE being the hub of technological advancement. So even now we are moving into the era of metaverse, where millions and millions worth of transactions are happening, events are being held there, virtual real estate is being sold there. How are these technological issues going to be addressed, if at all they persist in UAE?
Who would like to take
that one? I'm happy to take it if no one else wants it. Okay. So look, I mean, the good news is at this point in time, as you point out, there is only one thing which will give you nexus. I think it's clear, and we've had a lot of questions around why is there a 0% withholding tax? Why do we have a long list of state-sourced income that covers basically everything, but then we still have a 0% rate of tax? We interpret that to be that at some point the authorities do have the ability to turn on a tap and say, actually, we are going to challenge digital business models, we're going to challenge certain other types of state-sourced income, and they've left the door wide open for that. Now, it's very difficult to predict when they will turn on, if they will turn on that tap. So what I would say at this point is looking at how we manage this in other jurisdictions. So there's many jurisdictions that have introduced digital taxes, GST, withholding tax, different variations on this, and thinking about some of the steps that we do in other jurisdictions. So, you limit your intellectual property locations, you think about restricting how you transact, how you structure your legal contracts. There are things you can do. That's if you want to be super prudent. But I would say right now, it's pretty clear we don't have a digital tax, either through withholding tax or anything else. So make hay while the sun shines. I don't know what the proper proverb is for that, but okay.
Thank you very much for the question. And the gentleman at the back with your hand up. Yes, thank you.
My question is, like, we have two companies. In case one company is in Oman and one company is UAE, and place of business is from UAE. Do we need to register as a group, or how it has to be done?
Dana, do you want to take that one?
These are two different countries. Oman and UAE are completely different. We don't have a GCC implementing states. I mean, this is not a EU region or anything. So your Oman, just to get a clarity on the question. So Oman, is it a LLC there?
Yes, it's a LLC.
So you must be already paying this is yes. There from 1970s there, and then here it's just an operation.
Yeah.
Okay, and you have got a place of business here?
Yes.
Okay, so you have to register a PE here, and your head office will be Oman.
Head office.
It's not a tax group.
Head office have to be in Oman.
Your head office.
Head office is in UAE.
So, so it's not a branch office here.
It's not, it's identical partners.
I mean, what is the legal structure here?
LLC?
LLC. So
LLC.
this is a separate LLC and that's a separate LLC.
Yeah.
So you file 2 tax returns, one in the UAE and one in the Oman, and that's it. So is it each other holding, like one holding the other, or they have common partners?
Common partners.
Oh, so they're just associated enterprises, that's it.
A microphone, please, sirs. If you could pass the microphone, please, so the rest of the crowd can hear. Thank you. I'm loving all the questions as open dialogue, so we've got a few more minutes, and I think we're going to go for lunch, but these are great questions.
Yeah,
Thank
okay.
you.
Actually, just wanted to ask this. Charles knows our structure, actually. If the UAE company, LLC company, holds the subsidiaries in other Middle East countries,
Yes,
so in that case, the income is consolidated here.
yes.
So that will be
Exempted,
declared as...
participation exemption. We've got a participation exemption here in the UAE.
Okay.
The dividends that's coming here. So that's where we started actually today's session, that the UAE law is already sort of consciously allowing the juridical non-double taxation. So they don't want to tax the income twice. So something that is distributed has suffered corporate tax in the other country. And when it is distributed, but then it has to qualify at least 5%, so that condition is there.
So if other countries, they don't have tax still, corporate
There
tax.
is no corporate tax.
For example, Bahrain and Kuwait, they don't have any taxation.
And then there is, you are distributing the dividend. Yes, that's fine. Yeah.
Thank you.
So
Anything to add?
Yeah, I just wanted to go back to grouping because Dana mentioned it earlier, and I kind of just wanted to share our thoughts on grouping generally. So, because I think there's an attitude, and I don't know where this is coming from, but that, you know, we have to get in a group, we have to get in a group. And I think as we've explored this with many clients, we're actually figuring out that on balance, grouping may not be that beneficial to you. And so, you know, I think people have this perspective that it's going to save you a lot of tax if you can form a tax group. In reality, you can probably get to the same tax charge just by transferring losses without forming a tax group. So the law allows you to either form a tax group or stay separate and then transfer losses between each other, and you still get broadly the same offset of losses. There's some scenarios where grouping might be better, but broadly the same. So when it comes to tax payable, generally no real advantage to forming the tax group. And I think, Dana, you already mentioned, you have to prepare kind of special purpose aggregated tax group accounts. So that, to some extent, completely negates the compliance benefit of that, you know, you save 3 or 4 returns with the tax authority because you just file one. The flip side of that is you have to prepare these special purpose accounts, and you may even have to get those audited. So from an administrative perspective as well, group is, in many cases, kind of neutral. So neutral on tax payable, neutral on administration. The one big area where it can be of real advantage is just transfer pricing. So if you have a complex UAE group with lots of intercompany related party transactions, the group allows you to say, we'll just ignore those for transfer pricing purposes. You don't need to price them. You don't need to document them. You don't need to benchmark them. That is a real material advantage in many circumstances. But, you know, I just wanted to make this point because I think there is still this sense we really need to get in a group. It will save us tax. In many cases, it just won't. It's really an administrative benefit, if anything.
You need to do the simulation to find out, and your simulation should not be just numbers, it should be also logistically, administratively, and the amount of time involved in this entire cumbersome process. So, yeah.
Great.
Thank you very much. I know that it's lunch, and I really appreciate all the questions, but once again, please pick the experts of our amazing panel. Very quickly, a minute from you all, if you don't mind, starting with yourself, Shama. Give me your real-life experience or scenarios when it comes to businesses that you've helped prepare for UAE corporate tax. So a quick 1-minute breakdown from all of you, please, on real-life scenarios for the wider audience.
I'll make it very quick. I can't think of any real life scenario now. We've helped a lot of companies, whether it's with their tax planning, tax structuring and all, but my advice to all is just before deciding whether it's a tax group, whether it's operating in a free zone, just really make a very thoughtful decision, because the benefits, everyone talks about tax. So think of whatever benefits your business. Something that could be beneficial for company A would not be beneficial for company C. A lot of people, as Charles said, are opting to form tax group when they can just benefit similarly of just being a qualifying group if they meet the criteria. So I've seen this a lot with companies that approach us for tax advice. It's just that entities would need to understand the law and where does it benefit their structure better than others, because the law is open to all, yet you have to pick and choose what really works for your type of structure. Charles, to you.
Okay, I was going to make a very similar point, actually. I mean, so PwC, we deal with some of the largest groups in the country, some of the sovereign wealth groups, some of the, real big conglomerates, right down to the kind of sole traders. And I would say, those that we're seeing deal with this well, whatever the scale, are the ones that are approaching this early. So thinking about it early, thinking about this on a kind of bespoke basis. So, I've heard someone say we should do this. It may not be applicable to you. You really need to think about this based on your own facts and circumstances. So I think thinking about it early, and we're already in it, so early is past to some extent, but as early as you can now. And then, so maybe the additional point I'd just add is around operational preparation. So I think, a lot of the conversation is, how do we reduce the tax? How do we, get a couple of percentage points off it? I think that will calm down over the next, 6 to 12 months as people start to accept this applies, and there's only so many levers we can pull to try to mitigate the tax. I think, for everyone in this room, after that, you're going to be dealing with how do we just comply with this on a day-to-day basis? How do we provide for it in our books? How do we file our returns? So again, thinking early about the operational side. So who's going to be responsible for it? Do we need to make changes to our systems? Do we need to get tax-specific systems? All of those kind of, people, processes, systems. Think about those early as well, because I think you'll save yourself some pain and heartache in the future.
So real life scenarios for me, there's a big range. Like there are clients who would have already a tax as a function in their organization to somebody who is still a non-believer about tax. There's a lot of information out there about corporate tax, but when you actually when they start looking at it for their financials, there's a lot of, they need a conversion to become a believer in corporate tax. So with some companies, we've started with the policy writing because they want a direction. Because although there's so much of information available about corporate tax, still, what is your company's tax management policy? This is very important. And also, if a company is quite sizable, then tax organization is very important, especially if you have foreign income and there's so many TP compliances outside the country, then you will have to really have that pyramid structure, how these reporting structures are going to be within an organization to do compliance. So this is quite a range, but it was obviously, it is sort of applicable to everybody. Yeah.
None of us said hire a good advisor. We were very...
I'm just wondering how much this advice would have cost if I was going to pay for it. So I think it's fantastic the fact that you've given this advice to the wonderful audience, and thank you for the questions. Dana, Charles, Sharma, this has been the UAE Corporate Tax Evolving Business Landscape. Thank you very much to the audience. Thank you for the questions. Let's give them a nice round of applause. And don't forget to pick their brains because it's going to be lunch, so please ask questions.
Thank you, Mr. James, Mr. Charles, and Ms. Dana, and Ms. Sharma for running up today's final session with such a thought-provoking discussions.